Good evening and welcome to our webinar, Ways to Boost Your Super Before Retiring. Tonight's webinar will run for about 45 minutes. It's being recorded and will be available on our website shortly. My name is Zoe Nikakis and I'm part of First Super's marketing team. Let me begin by acknowledging the traditional owners of the custodians of the land on which we meet and paying my respects to their elders, past, present and emerging. I also extend that respect to Aboriginal and Torres Strait Islander peoples attending this event. Firstly, thank you for joining us tonight. We encourage you to ask questions using the Q&A button at the bottom of your Zoom screen. Questions are anonymous and we will do our very best to answer them all. Before handing over to our financial advice team, there are a couple of important housekeeping items I need to cover. First up, the agenda. On tonight's agenda, the financial advice team will cover topics such as information about First Super, what does your retirement look like, will you have enough to retire, how to build your super while working, and then they'll take any questions. Now, it wouldn't be superannuation without some disclaimers. The content in this presentation has been prepared by First Super and may not be used or reproduced without prior written consent. The information in this presentation is accurate as of today's date. First Super has engaged industry fund services to provide financial advice to our members, and all our financial advisors are authorised representatives of IFS. Further information regarding the cost of advice is set out in our financial services guide. The information in this presentation tonight explains concepts, strategies and ideas in a general way. If you feel it could be applicable to your personal situation, we recommend you obtain a financial advice before taking any action. Now, before I introduce the team, I'd like to share a bit about us at First Super. We're an industry super fund with 70,000 members and about 4.5 billion in funds under management. We have a dedicated member services team and we provide local personalised service through our team of coordinators who are located around Australia. You can take us with you for life, from accumulation into your transition to retirement, an account-based pension and much more. Now, let's get to it. Joining us tonight is Andrew Jewell, our Executive Manager, Financial Advice and Education, and financial planners, Jason Bruce and Richard Gosling. Please welcome Andrew.
Thank you very much, Zoe, and welcome everybody to our webinar. So tonight we're going to be exploring about those people that are considering retiring, whether it's in the next 12 months, 2 years or 5 years, but thinking ahead and thinking about whether they need to boost their superannuation before they do actually retire. So we're going to look at contribution strategies in particular, and one of essence is the transition to a retirement strategy, or what's more commonly known as TTR. But whenever we sit down with our members to have a discussion with them about their retirement plans, the first thing that we try and do is understand what it is that they want to do in retirement. And we refer to something called the ASFA retirement standards. And I'm going to actually ask Jason just to have a chat and explain to us what is the ASFA retirement standards all about. So Jason, would you mind just explaining what we're just seeing here on the screen at the moment?
Thanks, Andy. So the ASFA retirement standard, what ASFA is, it's effectively an association or a body that goes out and interviews retirees to determine what sort of lifestyle they're living and how much that lifestyle is costing, so they can provide a bit of a guide as people are stepping into retirement. So normally when we do meet with members that are retiring, a key part of it can be budgeting and working out what you're needing to spend, so we can determine whether that's affordable for you and what we can do in that sense. But for a lot of people, it can be a really cloudy thing to step into, or we may not know what that looks like. So these retirement standards can really provide us a good guide rail to step into retirement and know what we're spending. So there's effectively two models that ASFA provide. The first one is the modest lifestyle and the second one is the comfortable lifestyle. And they're just descriptive terms. With your modest lifestyle, generally what we speak about when we speak about the modest lifestyle is that you focus on really your home being a key part of your retirement, home and family being really important to you. So spending a lot of time at home, doing the gardening, maybe some small trips, not going out for tea a lot, having the kids over for dinner rather than going out for expensive meals. So it's a little bit cheaper on that side of things, but it's still a nice lifestyle that you can live. Whereas your comfortable lifestyle, we really refer to that as an active lifestyle. You can see there you've got the couple going on a cruise, so there might be a lot of travel overseas or definitely interstate travel, going out for dinner a lot, enjoying some finer things in life, upgrading the car and the house a little bit more often in retirement. So you're doing a little bit more, you're spending a little bit more, and that's going to cost a little bit more accordingly.
Okay, so you gave us a good description there of around about the different lifestyles that people may want. So normally when we do explain this to our members, the next burning question is well, how much income do I need around this? So again, based on these models, ASFA has come up with some indication about potentially what type of income a person may need. So if we go to the next slide, and Jason, if I come back to you and just get you to explain what are these figures showing us?
Sure. So the modest lifestyle, and it obviously is different for a single and a couple. If you're living at home, you're sharing some expenses here. So you can see those figures there. So just looking on the single side of things for the modest lifestyle, you're looking at about 33,000. So it's a little bit over $1,000 a fortnight. For a couple, it's sort of creeping up to close to $2,000 a fortnight for that level of income. For a comfortable lifestyle, you can see it's $2,000 for a fortnight for a single and $3,000 effectively or close to a fortnight for a couple. So it's quite a lot more in that sense for both a single and a couple. You're certainly doing a lot more. The idea of this as well, just to sort of clarify, it is a net amount. Okay, so it's an amount after tax that you would get. So some people will compare it with their wage and say, oh, I'm on X amount a year, but this is a net amount, assuming that you're paying no tax. So that's sort of what you need in retirement. So the funds that you'll need for that, and there is a range of assumptions that ASFA do provide for this. So you do own your own home in this situation, so you're not paying rent, and you're reaching your pension age as well. So the funds that you'll need for a couple or a single for the modest lifestyle is around about 100,000. You can see for a comfortable lifestyle, 595,000 for a single and close to 700 for a couple. There are a couple of reasons for that being such a significant gap. So the first one is around the age pension. So the idea with the modest lifestyle, your age pension is providing a majority or a bulk of your income needs. So your super or the funds that you have is just providing a little bit of a top up to meet that modest lifestyle. Whereas in the comfortable lifestyle, the age pension is providing, not an inconsiderable, but not the majority of your funds. So your super is providing a real majority of what you need in retirement. Therefore, you've got to have more funds to afford that.
All right, great explanation. So thank you very much for that. We started to get some questions through, and some questions have actually come through before the webinar, so we will answer them as we go through where it's relevant. Otherwise, there is a Q&A session at the end, as that we will come back to those questions that haven't been answered throughout the presentation. But okay, so we've got an idea now about, all right, this is how much income, this is the lifestyle I want in retirement. Consequently, this is the income that I'm going to need. And to generate that income for the rest of my retirement years, I'm going to have to build up this amount of funds around. So how do I know whether I'm on track or not? Well, one of the services that we do offer is what we call a retirement health check. It's a projection, basically just saying that if you continue doing what you're doing, by the time that you reach your preferred retirement age and you start to draw down what you want in retirement, are your superannuation funds going to last long enough in conjunction with any other sources of income, whether it be other financial assets or it's the age pension, as Jason made reference to before. So, okay, what does this look like? And I'm going to actually hand over to Richard, and we're going to take you through a retirement health check. So again, just to let you know, it's available. It's just a 30-minute conversation with us. Whether your partner is a member of First Super or not, it doesn't matter. This service is available to our members, and we will include their partner and their superannuation, even if it's held with another super fund. It's about giving our members and their partners a clear indication. And if you're single and you're a member of First Super, again, this is all available to you. So, Richard, let's move over to this kind of like case study that we got, and if you can just take us through this, please.
Yeah, so thank you. So basically, we have a situation where we've got a couple have come in having a bit of a chat. We can see Barry and Debbie are both 59, a few years out before pension age. And basically what we've got is the situation regarding their superannuation. So quite clearly you can see that Barry's been working full time for 40 years. Debbie's been doing part-time work for the last 7 years. They have four children that don't live at home. They've paid off their debt, which is obviously important. That's one of the biggest things we want to look at, is that if we can avoid having debt in retirement, all the better. They are considering the prospect of downsizing their house and moving into a smaller unit at some point in the future. And obviously we can see there from there what their superannuation balances are looking like at the moment, and income. So importantly, Barry hasn't been salary sacrificing. There's some opportunities there to, obviously, when we start to look at what he was positioned like, as providing some advice. They've got an objective. They want to look at retiring in the next 5 years. However, they're unsure if they have enough money in superannuation. So what we would basically do is we would have a look at their investment options. So you can see there we've got balanced investment approaches being for their superannuation. And ultimately we go through and gather information and then make some projections, which will come up on the next slide. Will give us an idea of where they are placed from there. This is made on the assumptions that we haven't actually given any advice. We're just looking at their position as it is right now.
All right, excellent. So, and to your point, let's go to the next slide, and then I'll get you to explain what it is that we're seeing in this projection here.
All right, so there's a whole fairly busy slide, as you can see. What it does tell us is if they were to retire at age 65 on that modest lifestyle, so that income at the lower end of the scale, we can clearly see the orange line tracking through with the dots on it, is looking at what their expenditure requirements. So we can see there they're in that around that $50,000 a year in retirement. And their expenses at the moment are a little bit higher than what they would have during their working life. We look at the income. So basically what we're looking at there is the blue line at between 59 and 60 odd years of age is showing their income and where that's coming from, and that's by employment income. When they stop working, they haven't qualified for age pension in this situation because they're under the age pension limit, which is 67. So they need to be self-funded for a couple of years. So the green line shows the assumption that we're going to utilise their superannuation in an income stream, what we basically would call an account-based pension, to top up that income and meet their living expenses in those first few years. Once they get to age 67, they're obviously going to be eligible for some form of Centrelink assistance. And we can see there the lighter blue line is where we start to get some Centrelink income coming in. The thing we need to look at there is to ensure that we are meeting that objective of the living expenses in retirement. And you can see there the income chart or the graphs with the bars coming up are actually exceeding that income needs. So they're actually providing more income than they need during the retirement years. And probably the most important graph at the back is the back, which shows us the shaded blue area. That is telling us that they are actually able to meet their living expenses through their retirement years, and they won't importantly, run out of capital during that period. If that line was dipping down below the age lines there, so we can see around 87, 91, we always make an assumption that their life expectancy will be beyond plus an additional 5 years. So in this instance, we've made the assumptions that they'll live to in their early 90s, And you can see there that they will still have somewhere around about 300,000 in capital available to them. If that capital was going to run out, obviously we wouldn't meet the living expense needs, and we would have an issue where they've run out of capital prior to them potentially outliving their retirement income capital. So that's probably where I find, from my perspective, the biggest issue most retirees have is their fear of running out of capital.
Absolutely, absolutely. And okay, so what we've done at this moment in time is kind of like just sharing with our members that are attending tonight. Okay, when you're thinking about retirement, you've got to start thinking about what kind of lifestyle it is that you want. And then, yes, we can do this projection that tells us whether you're on track or not to meet that desired retirement lifestyle. And to your point, Richard, that you mentioned then, is that there's a lot of instances where it doesn't actually happen, or the members fear about running out of money and they just want to simply increase that amount of superannuation by the time they do retire. And then this is consequently what leads us into really the key part of all tonight is well, how do I boost my super before I do retire? What if I do want more money in my superannuation account by the time I retire? Or what if this projection is showing that, for the lifestyle that I want and the way that I want to spend my money in retirement, I'm going to run out of superannuation as well. So let's kind of switch over to the contributions. And Jason, I'm going to switch back to you just to explain what are the options that we've seen here and explain those to us.
Yeah, excuse me. So yeah, either way, whether you're on track or not, it's always good to make things better and give us more meat on the bone to potentially do an extra trip or to do those things in retirement. So as you're sort of getting there are a couple of great ways to build your nest egg and build your super up. And it does depend on your situation, your circumstance, how much income that you earn and how much that you have in terms of which contributions option is right for you. So there are two main types of contributions. The technical term, we call them concessional and non-concessional contributions. But what we'll refer to them today as either before tax or after tax contributions. So the first one we'll focus on is your before tax contributions. These are the ones.
Sorry, Jason, just before you go, I mean, we did get a question in before the webinar tonight, and you're leading off before the tax. And the question was, how do I reduce my taxable income? So again, maybe while you're explaining this one, you could relate back to that question.
Sure, absolutely. So your before tax contributions are the ones that can potentially reduce your income tax. The idea of these before tax contributions is that you divert some money from your wage or from your bank and you'll put it into super before there's any tax applied to it. Now, these before tax contributions attract a rate of tax of 15% going into your super fund. So most ordinary Australians, depending on your income, if you're working full time, a lot of the time you'll fall into that now 30% bracket of your marginal tax rate. All right, so that's where your salary sacrifice or your additional deductible contributions can be better. Rather than paying the full rate of tax and having that money come into my bank account, I can put it into super and get taxed at only 15%. So that's your salary sacrifice, which most people will commonly know. Your employer contributions, so your standard contributions that work will put in, accounted towards that as well. And you can also do what's called additional deductible contributions. So effectively what that is you've got some money in the bank, perhaps saved up, and you want to put it in super. You can actually claim that as a salary sacrifice type of contribution as a lump sum and reduce your tax and get you a little bit of a tax return at tax time. The thing to be mindful about with the before tax contributions is that there are limits. So for this financial year that we've just commenced, 2024-2025, it's just been indexed up to 30,000 per financial year. And on the next slide, we'll go through the carry forward rule in a little bit more detail, which may allow you to go over and above that cap. So that's your before tax contributions, and that sort of may answer the question about reducing tax. It's a very effective way. We can invest anywhere, but the benefit of super is that it's invested potentially at a lower rate of tax than you would investing that money personally or having it paid into your bank account.
And before we go on to the after-tax one, and again, we got another question in before the webinar tonight, and that was someone asking the question as in, how much super saves tax if I'm earning 45,000 a year? And in a way, this leads into the next type of question. If you can just elaborate on that as well, please.
Yeah, sure. So which contribution option is right for you depends on the amount of income you earn. And, you know, if you're only earning a little bit of income, you're not paying a lot of tax. Okay, so I had, and just a quick example, I had a member who was working casually at a local food works and earning about $20,000 a year. So she wasn't paying any tax. So she said, is salary sacrifice right for me? Well, it wasn't right for her because putting that money into super at 15% would leave her worse off as opposed to taking that money in the bank and getting it tax-free effectively because she was under what's called the tax-free threshold. So that's where if you've got a little bit of surplus money and you're not paying a lot of tax personally, your after-tax contributions may be more beneficial. Now, these ones go into the super fund tax-free, so there's no additional tax that you pay on it. But there's obviously no additional tax deduction that you get like your before tax fund. So it tends to be if you're a lower income earner, or certainly if you've got a lot of money sitting in the bank that you're looking to invest, because that cap is higher. So it's 120,000 per financial year. And you can use what's called the bring forward rule, which is effectively grabbing future years and bringing it forward to do up to the 3 years worth. So 360,000 as a one-off shot. Now, obviously, that can be very important if people are leading into retirement, they've saved a little bit, maybe they've sold a property, maybe they've received an inheritance themselves and they've got a lot of money and wanting to invest that. That's where your after-tax contributions can come into play. And also the last bullet point there is one of the most important ones, so the government co-contribution. So if you're a lower income earner and you're earning under what the threshold is, and you put in $1,000 as an after-tax contribution, the government will match that up to 50 cents in the dollar, so to a maximum of 500. Now that basically tapers, so if you're over that minimum threshold, they'll slowly reduce it based on the extra income that you earn. So the more you earn effectively, the less of a government co-contribution that you'll get. So they get to the maximum point and they'll cut you off and say that it's not worth it. So it tends to be if you're sort of under that threshold, your after-tax contributions can be more beneficial. Whereas if you're over that threshold, your before-tax contributions are certainly worthwhile for you, or even a combination of both.
All right, a good explanation. So, I mean, to your point, you know, considering which type of contribution option a member should select, or a combination of the two, can actually occur as well. It really comes down to your assessable income and what marginal tax rate you're on, and you know what's the most effective way in which to contribute those funds and boost your superannuation. But you were talking before about the before tax and this kind of like carry forward rule, and it's, if you want to describe it, it's relatively new, as in terms of superannuation and all the strategies that we've had around for years. This one's come into play in the last couple of years around that, and there's a growing awareness around this particular option. So we're going to move to the next slide, and to your point that you made earlier, it'd be great if you can just take us through this example.
Sure, yeah. So the carry forward rule started around about 6 years ago now, so it does feel recent, but time moves very quickly in the space. So it started in 2018-19, and it works on a rolling 5-year basis. So they're sort of at the end of that first initial 5-year period, and that'll keep going on. Now, for you to be eligible for this, your super balances at 1 July at the start of the financial year, or 30 June the previous year, must be below 500,000. So that'll be what you've got in super and or transition to retirement account. Right, so that's very key. If you've got more than 500,000, you're just not eligible for it. Now, what it effectively is, it allows you to utilise your unused cap in previous years and carry them forward and compound that over time. And I'll work through this example here to make it make a little bit more sense, because it is a little bit complex in its application. So the first thing is that the concessional cap here, you see in the table, the first bit, the annual concessional contribution cap, so it's your before tax cap or limit, has changed over time. They're always changing things. It was 25,000, then 27.5, and now it's up to 30. So over the last 4 years, this individual, Sylvia, who had less than 500,000, so she's therefore eligible. For the first couple of years in 2021 and 2022, she just had her employer contributions of around about 6,000, 6,500 be put into her super account. So she wasn't doing any salary sacrifice. That means she had quite a bit of unused before tax or concessional cap, which is rolling forward and accumulating. So in 2023 and 2024, she did start to salary sacrifice here. So some additional contributions, we'll assume that they're salary sacrifice, but she's still carrying forward more and more cap as she hasn't used the full 27.5 in these financial years. So you can see that the carry forward amount at the bottom right of 70,850. So what would theoretically happen for Sylvia this financial year is that 70,850 would be added to her standard 30,000 cap of this financial year. And technically she could put in up to around $100,000 as potential salary sacrifice or additional deductible contributions into super. So obviously for her, and depending on your situation, you've got to have the cash flow or ability to do that. Obviously, if this example, Sylvia was on 65,000, so it probably wouldn't be worth her salary sacrificing $100,000, but it'll give Sylvia the flexibility to potentially tap into some of that unused cap and accelerate her super savings while really reducing her tax.
All right, and so you kind of hinted at it before. I mean, this amount that you're accumulating, it doesn't mean that you've got to use all of it. It's about determining how best to use it. So what's a couple of ways that the member could actually use this carry forward amount that they've accumulated?
Yeah, so you can obviously look to utilise it as a salary sacrifice or a regular amount. If you do have some additional savings that you want to use, you can look to put that into super as a lump sum and claim that as a tax deduction, which could save you a fair bit of tax as well.
All right, so I mean, you don't have to use it all in one lump sum. You can spread it over the next number of years if you're planning to retire in 5 years' time, just to minimise your income tax. And to your point, as long as you've got the cash flow or the funds in which to do that in that respect. And can you give me an example where you just actually assisted a member utilising this very strategy?
Yeah, sure. So I had a member come to me a couple of years ago, and she was in her late 50s. Her husband had retired and had built up a super. He was a few years older, so he had his super. Now, they had a little bit of savings, and she was a similar situation where she was just receiving her employer contributions, and she was on a good income of around about 100,000 per financial year. So one of her concerns was she was paying too much tax, and she wanted to minimise that. So what we actually did in 2022, 2023, and 2023, 2024 was utilise what her unused contributions and contributed $40,000 per financial year in each of those 2 years as an additional deductible contribution using a combination of their savings and withdrawal from the elder husband's account. Now, that saved her around about $12,000 net in tax in each of those 2 financial years. So she was around about $25,000 better off tax-wise. It obviously built her super up as well. And then from this financial year, she'd used most of her carry forward. So what we were doing, she's still working for another couple of years. We're just accelerating her salary sacrifice up to that $30,000 cap. So we're maxing that now over the next couple of years. So sort of the strategy in combination, utilising the carry forward rule with this additional deductible contribution with the salary sacrifice, and we're going to save her well in excess of $30,000 to $40,000 in tax over the sort of 4 or 5 year period into her retirement.
All right, wonderful, very good. And again, for members that are attending here tonight, or be watching this video webinar later on, if you want to find out what is it that I've got in this carry forward amount, you can go to MyGov ATO Super, and if you look underneath carry forward amount, it actually tells you what you had. So if you go in there at this moment in time, it will be for the last financial year, and it tends to get updated around about November each year. And I think also then around about April or March, April at that time as well. So the point being is that if you can go in and actually have a look and see how much of this carry forward amount is available to you to utilize. that's coming and how to use it. I mean, to be honest, that's where the financial advice team comes into play. We can sit down with you, we can work out what your objectives are, what your cash flow situation is, and then we can actually give you advice around how best to utilize this strategy if it's available to you to really grow your superannuation and, more importantly, minimize your income tax for the next couple of years until you retire. So again, what we've spoken about so far about these contributions is that if the members got the cash flow, or they have, if you want to describe it as some surplus funds in which they want to put into their superannuation. But for some of our members, they don't have that cash flow, but they certainly want to be able to boost their superannuation. And that's where we kind of like move over into what we call the transition to retirement. It was one of the original reasons that it was introduced. And I'm going to get Richard just to explain this slide to us and just the options around it as well, please.
Okay, so transition to retirement was basically a government initiative that was brought through. And what the mandate they were looking at was that there was obviously going to be some people that potentially wanted to be able to work less, but still need a level of income. And obviously when you work less, you're working fewer hours, your income is going down. So they recognised there was the opportunity to potentially draw from your superannuation with some limitations and some rules around it in order to fulfil that income gap. So a TTR basically is effectively your accumulation super being pushed across into an account-based pension, being a TTR pension, but there are some restrictions around it. So there is based on age, because in most cases people haven't reached haven't satisfied a condition of release, you'll be able to draw up to a maximum of 10%. So there are some limitations. You can't actually go in and draw from it as a lump sum. It must be provided to you on a pension payment. As a result of that, the strategists sat down and we looked at potentially an option there to look at growing your super faster, but also paying less tax. And generally we use this TTR strategy in line with a salary sacrifice arrangement. So obviously where you're salary sacrificing, you're reducing your income because you're contributing that into super. At the same time, we can use that to offset by setting up a TTR pension to provide some additional income to replace some of that salary sacrificed income. So in a lot of cases, we'll sit down with a member and we'll actually do some calculations and work out, can we actually provide a strategy where your take-home pay really doesn't change, just comes from different sources, being your employer and your transition or retirement pension. The advantage of that is because it's foregone salary, as Jason's just gone through with the deductible, the tax deductible before tax contributions, you're actually able to save some tax on the way through. So pretty much that strategy is looking at growing your super quicker, but also paying less tax. And that's pretty much the way we look at the two options that we've got. As I said, I've seen both options where we've used it to support someone who just wants to reduce their hours, but also we have used it with a number of members around just trying to minimise their tax implications as well.
All right, great. So we've actually got two questions that have come in before the webinar, and there's one tonight that's come up as well. But I'll just start with the first question and just get you to maybe just repeat again. The question was, what age is the maximum age you have to be to open a TTR account, and is there a maximum age it finishes?
Okay, so transition to retirement basically is eligible for someone who has reached their preservation age. Haven't got access to your super because you haven't actually satisfied a full release condition, which will generally be retired from the workforce. So someone that has not retired but got to their preservation age, so at the moment that is 60 years of age. We have had it previously where several years ago that age was at 55 and that's been progressively increased. We've got to the point now in time where anyone that is actually 60 years of age will have satisfied the preservation rules. Because you haven't actually got access to your super, as I said, we're in this transition and retirement basis. The maximum age, well, most people will keep it in the transition and retirement until they actually finish work. So if you're 60 years of age, plan to retire in 3 years, that would be 63 years of age. Basically, what happens is you then have met satisfied a condition of release if you've retired. So the TTR strategy or the TTR pension actually becomes across into a full account-based pension. The other option there is to wait until you're 65 years of age when you will actually move from a TTR pension into an account-based pension, which just happens at 65 years of age. The biggest difference between the two is a TTR pension will still attract tax on the earnings of the fund, so the investment income that it has, which is taxed at 15%. But when you go into effectively an account-based pension, there is no tax payable on the income of that particular investment. So there's a difference between the two, and around the age base is probably the key thing. 60 years of age minimum would be looking at now, and the maximum age I would say for a TTR would be looking at 60 years of age, but prefacing that with if you retire earlier than 65, then you will have access to that, and effectively the TTR would be transitioned across into a normal account-based pension.
Okay, great. And I guess on that last, or on both of those points that you raised now, kind of lead into the second question. And interesting enough, they're both center around an investment property. So one of the questions we got is, can I use super to pay my investment property? And the question we got tonight is, I'm 62 years old. Is it worth to pay off my investment property loan with my super funds? The rental income would be my only income. And admittedly, the second question is getting very much into what we call personal advice. We can't answer it directly, but the TTR strategy certainly offers an option for both of these members. Could you just maybe add a little bit more to that?
Yeah, so as you said, it's prefaced with personal advice would be required in this instance. But from a general perspective, a TTR, yes, you could use a larger 10% payment at the maximum level and do an annual payment to reduce some debt. And I have used that with not so much in an investment property scenario, but with a home loan scenario. The issue I would have generally with using superannuation just to pull it out and to reduce debt is that may not be in your best interest longer term. As you've probably seen, the contributions have caps on them. So the government has made it difficult enough to get money into the superannuation environment in a restrictive position as far as the amounts are concerned. I would be more inclined to look at where do we sit with doing some projections to see, are we better off to draw that out at retirement to clear debt, or are we better to do that as we go along? And that's really where the advice is critical, because we can actually compare the scenarios and give you some advice to determine exactly what is the best outcome for you.
Yeah, I totally agree on that one. So yeah, the concept of TTR is certainly an option, but what is the best option for this particular member? The one that's 62 and the rental income will be his only source of income in retirement. I mean, that really does require personal advice and a lot broader conversation and an exploration around these circumstances. But, the point being is that it is an option or something to be considered in that regards. So that's great. So this is a TTR strategy. So again, coming back to my point before, there's an option here where members can utilize this strategy. If they don't have the surplus savings or the cash flow in which to do it, it's a strategy that allows them to create that situation for them and boost their superannuation before they retire and reduce their income. Or it can be used where someone's actually looking at transitioning into retirement, hence the name, and they want to reduce their hours, but they still require the same level of income. And there's different ways that we can use this strategy, as Richard has already elaborated to, and especially where people have got a home loan that they're needing to pay off before retirement. This is potentially something that we could assist them with in achieving that objective. So we've talked about the main types of contributions. I mean, TTR certainly comes back to that before tax contribution, and the carry forward rule, it can be applied in this situation as well. We've utilized it there. So they're the main two, before and after tax. But there is a third one that the government introduced a couple of years ago as well. And it's called the downsizer contribution. And again, Richard, if I can just go back to you and just get you to explain, what is this downsizer contribution all about?
Yeah, so what they've looked at is a lot of people, their biggest asset is generally their house. And second to that, maybe their superannuation. depending on how much that has been built up over years. But what they've basically allowed is once you're over 55 years of age, you've been living in a home for more than 10 years, and you decide that you want to move from a larger home into a smaller home, and you may realise some equity out of that property sale. So what they've basically allowed us to do is to look at potentially contributing that into superannuation. And obviously the key thing there is, depending on your circumstances at the time, it may or may not be appropriate for you. Bearing in mind that if you're 55, you won't have access to your super until you're 60, at best case scenario, assuming that you've retired. But what they've allowed us to do is to actually put a contribution into superannuation, but they have put a limit on that of up to 300,000 per person. So in a case of a single person owning a house, they can put 300,000 in. If you are a member of a couple, you're entitled to put 300,000 each, so a total of 600. But that will depend on the ownership. So if the property is jointly owned, husband and wife, for as an example, and you've realised 600,000, you have the ability to contribute that into superannuation. Obviously, if the house is in a single name, there is the only ability to contribute up to 300,000 for that individual. This contribution falls outside of the previously mentioned caps, so as an additional option, but there are some restrictions around it. So timing is critical. You have a certain period of time from the day of the sale to actually contribute the funds, but I would suggest that obviously looking at that, I would ensure that you get some advice around it to make sure that you aren't running afoul of those contributions and the timings, because if it's not done correctly, then you may actually start breaching some additional caps that Jason went through a little bit earlier.
And if you're of pension age, and you're thinking about using this,
so it is open. Basically, it's a means you can do this at any age. I actually had one for a 90-year-old woman probably about 12 months ago that was looking at a downsize of contribution, and her family wanted her to potentially put that into super and start a small account-based pension from the proceeds of that. So that was what we've done. So there is no actual age limit per se for this particular contribution or activity testing, etc.
Yeah. And for those that are on the age pension, they've just got to be careful that they're just converting a non-assessable asset into an assessable asset from the cash side of things as well, which could have an impact. And back to Richard's point, if you're thinking about using this, thinking about this strategy and this type of contribution, it's highly recommended that you get some advice around there just to ensure that you're not also being detrimental to your financial cash flow as well. We've got two new questions have come in, and one relates directly back to this downsizer contribution. So Richard, I'm going to put it back to you, and the other question is about the TTR. So Richard, I'm coming back to you again.
Yep.
You're on the hook. And the first question around the downsizer: does the house in the downsizing contribution need to be the house you lived in, or can it be an investment property?
No, it needs to be your main residence. So it has to be the primary residence. Investment properties won't be considered for this particular strategy.
All right, thank you. And so going back to the TTR, the question is, if I choose to work full time to say age 68, can TTR still be used?
Yes, but I've probably alluded to it. At 65 years of age, you would probably look at it being restructured into an account-based pension, not a TTR pension, purely around the tax from the investment income that your superannuation or your pension would actually earn. As I said, the difference is, whilst you're in the TTR strategy, then you are being taxed at 15% on your earnings for your superannuation. If you're over 65, you will have the ability to move that across into a standard account-based pension, and therefore that tax is zero on any earnings of that particular investment.
Yeah. And the other benefit, as you mentioned before as well, is that while you're between the age of 60 and 65, there's only the maximum 10% you can take out each financial year. But once you got to 65, that cap of 10% is removed. You can start taking out as much as you want in that respect, because you have met, and you mentioned it before, what is called the condition of release in regards to that. All right, so we've kind of like covered off all the different types of ways that people can boost their superannuation by making additional contributions around that. And we've answered some questions as we've progressed through. We did get a lot of questions in before the webinar, but strangely enough, they're more around about retirement, how to draw down against your super, the age pension, and again, the investment property also popped up on a couple of times around there. So in regards to that, we do have another webinar that's available on our website now, and it's all about retirement and the age pension and how the age pension and the superannuation can work together to give you an income in regards to that. So we highly recommend, if you're interested in that, to watch that particular webinar. Like I say, it's available on our website. But for everyone that's submitted a question before the webinar here tonight, we will follow up with those members and make sure that we've answered their question directly. Or if anyone from tonight has a question after this webinar, by all means, you can go, there will be an email that's sent out to you, and you've got the opportunity to pose your question to the financial advice team, and we will give you a call to discuss it through. And admittedly, just at this moment in time, it may be a couple of weeks before we come back to you in that respect, but the option is going to be there. So we don't seem to have any more questions tonight, but remember, the financial advice team is here to make sure that we're helping our members maximize their age pension, boosting their superannuation, and how best to draw down their super when they do reach the retirement age. And just to clarify, where the advice is just around the member in their first super account, there is no additional fee for that advice. It's part of your membership fees around there. Where a fee comes into play is where that advice is not only incorporating your first super account, but it also it requires advice around maybe debt, the age pension itself, or if you're wanting your partner to be part of the advice as well, and their superannuation is held with another super fund, or even as a member, you've got super held elsewhere. The rules that govern the superannuation funds simply don't allow us to incorporate that into your member fees. So we must, regretfully, charge you an additional fee for that type of advice. But just to highlight, the advice is there, and we're here to assist you in those respects. And strangely enough, we've got one of our members on the screen here, Terry, and both Jason and Richard have actually provided Terry with some advice over the years. And so, Jason, if I can start with yourself, and then I go to Richard. But you're the first kind of your encounter with Terry and the advice that you gave him was actually around the TTR strategy. So, can you just elaborate what it is that you did for Terry in regards to that?
Yeah, so I saw Terry for the first time probably around about 4 years ago, and he just turned 60 at the time, or was around about there, and obviously wanted to start structuring things as he was starting to think about retirement. And transition to retirement, which he'd heard from workmates and other colleagues. It was something that might be able to help him. So what we did with Terry, he had a little bit of spare cash flow, so he was able to do a little bit of salary sacrifice off his own bat. So he was able to make a little bit of additional contributions, but he still had some room within that cap of 25,000 it was at the time. So we utilised a transition to retirement strategy to make some additional deductible contributions into his super account, which saved him a little bit of extra tax and built up his super while he was doing his salary sacrifice. So we did that for a few years, started to talk to him about retirement and started to get him ready. It's certainly a good time because it's for a lot of people riddled with a little bit of anxiety that the working life is coming to an end and they're not going to have any income from work. So there's a lot of coaching that we did during that period around those projections. Terry, you're going to be all right, and building up his situation. So we probably did that for a couple of years and got him into a nice spot.
Excellent. And then later on down the track, Richard, you actually then met with Terry because you're our permanent financial advisor now based in Mount Gambier, and Jason was visiting that area before you were appointed. So just coming back to Terry though, you then met with Terry when he wanted to step into retirement. So can you take us through what kind of advice you gave to Terry at that point in time?
Yeah, so I basically first met Terry, would have been prior to the end of the financial year, the previous financial year. And we did effectively do just another small transition, retirement, pension and contribution strategy for him. During that meeting, Terry was still a bit apprehensive around his actual retirement. and when he would retire. And he'll probably be the first to tell you that he was a bit it was a difficult decision for him to actually make that actual final call. But in saying that, some circumstances locally in his workplace sort of raised the flag to him that he now needs to get a bit more serious about actually getting a date. So one of the things I did is I sat down with Terry and we actually went through and started to do what we call comprehensive advice. He'd been at that point in time looking at just the limited advice within his super and hadn't gone beyond that. But we needed to do a bit more work. So to give you an idea of what we did, quickly overviewing that, is that Terry did have 3 superannuation accounts, including his first super. Because we looked at trying to tidy that up, we consolidated those superannuation accounts. At the same time, we reviewed and then looked at his investment strategy and made some changes to that investment approach, trying to reduce some of his his short-term risk associated with his fund, because he was a little bit obviously apprehensive around what markets were doing. We got him to continue to do his salary sacrificing. So this is probably around February. We would have caught up with him this year. We made sure that he continued to maintain his salary sacrifice up until his retirement. I did a lump sum contribution for him for some money out of his bank account to get him some additional tax relief from there. And then probably the biggest thing was to actually talk about planning a retirement date. So we determined that he wanted to finish in 3rd week of June. So we actually went back, looked at his long service leave and annual leave, and actually worked out a date where he could basically go on, start commencing that leave. So from that, we actually determined his final date. Looked at his life insurance and TPD cover that he had inside his fund and determined, because he wasn't going to be needing that moving forward due to retirement, we actually made some recommendations around what to do with that cover. He needed to have an amount of money sitting in the bank as a cash reserve, so we made sure we had that set aside for him. And then we looked at ensuring that he had some income up until pension age, to ensure that he had that. And after the consolidation of his super, we commenced a new and account-based pension for him. And that's now providing him with the income he needs to meet his living expenses. There'll be some adjustments of that in a short period of time, probably 12, 18 months, when he'll qualify for age pension. And then we'll look to reduce the account-based pension income so that he's not drawing an excessive amount from his superannuation and building up the bank account, because we've done a hard job in getting it into super. We want to leave as much as we can in there. And the last piece of advice that we provide to him was to look at, because of changed circumstances, look at the low income healthcare card. So we made sure that he was aware of that. And obviously we've gone down from that particular path. So the big thing with Terry was, obviously, we walked him through the whole process, made sure that he was comfortable with that. And he probably looks a bit like he does now, quite a big smile on his face. So
Happy. Excellent. All right. Well, thank you very much. We do have 2 last questions, so we'll quickly cover them off. One question is how can I get financial advice? There's the contact centre you can phone on the 1300 number. There is our website that you can fill out a form, and it will come through to the financial advice team and we will contact you accordingly. Alternatively, there will be an email that comes out following this webinar to all those that have registered with their email address. And within there's the option of actually requesting that the financial advice team get in touch with you. And the last question was, how much does it cost to get more detailed advice? So just to clarify again, where the advice is just around the member in their first super account, there is no additional fee. It's part of your member fees. The additional fee comes into play where the advice topics are not only including the first super advice, but it's also about other advice topics like debt, superannuation held elsewhere, or something of that nature. And again, we will sit down with a member and we will explain what those fees are, but it's coming back to really just clarifying with the member exactly what it is they're there after, and then we will scope the advice and inform them of the fee accordingly. All right, so we've gone a little bit over time, so apologies about that, but I hope everyone's found it informative and it's clarified maybe a few questions for a number of people. And like I said before, for everyone that has submitted a question, we will follow up, and there will be an email also to all those that participated tonight, seeking your feedback on how you found the night. We're always looking for improvements, but also gives you the option of reaching out to us to get in contact. So again, thank you very much for attending tonight, and take care.